So yeah, good morning everyone. We are good to go. We can start webinar. So actually, welcome to our comprehensive tax planning webinar, and we are excited to have you with us. And we are gonna dive deep into the one of the most important part of the financial planning thing. That's gonna be strategic tax planning. So as per a fact or a data, so did you know that according to the Central Board of Taxes, only about 5% of the India's population files or pays income tax. Yet, tax planning can help every taxpayer potentially save thousands of rupees each year. So today we are not just going to talk about compliance as on what tax regime, what are the deductions, but we'll let you know it's like what are the smart financial moves that you can implement in your life to make most of this opportunity. Apart from that, we'll also dive deep into the current income slab rates in India, uncover all the available deductions that you can make most of, and also analyze some real life case studies and showcase how impactful strategic tax planning can help in, because we all know like every rupee saved in taxes that can be invested for a future goals, right? So yeah, without further ado, we'll start with the webinar. So to start with the basic itself, so right now, as you might be all aware of, there are two slab rates or two tax regimes that are available for Indian taxpayers. One is old tax regime and one is new tax regime. So if you see under old tax regime and new tax regime, one thing that you might find difference is the slab rates and the tax percentage is different for the both, right? So under old tax regime, the slab rates and the tax percentage is kind of on the higher side. But there's a catch. In old tax regime, you can make all the tax saving investments, deductions, and yeah, like contributions and reduce the tax liability. But whereas in new tax regime, you are not like allowed to make tax saving investments. You are allowed to make tax saving investments, but you won't be eligible to claim it under new tax regime. So hence the tax rates under the new regime is going to be a bit on a lower side. So let's say it's like we'll surely talk about some case studies on how to choose what tax regime is going to be suitable for you. Before that, it's like one thing that is to be like pointed out is like under the new tax regime, if your income is below 7 lakhs after the standard deduction of 50,000, you are not liable to pay any taxes under the new tax regime. But whereas in old tax regime, about 3.5 lakhs, and so you have liable to pay taxes. So let's say even if you're liable for not liable for paying taxes under the new tax regime up to 7 lakhs, you have to file taxes and you can get the credit back as an income tax credit. So that's going to be a factor. Apart from that, let's say it's like, okay, you would like to continue this old tax regime and so on. We'll also cover some tax saving deductions that can help you out in making most of it. Moving on to the next slide. Yeah. So it's like usually a lot of salaried employees and existing clients or literally our employees and colleagues too face this curiosity and doubt about what is the way to best optimal way to minimize the tax liability. Are we usually optimizing all the IT Act provisions? And what are the things to be safe and aware of to avoid any future penalties from the income tax authorities? And with keeping all these things in mind, what are the best way to increase the savings with disciplined way of investing too? So yeah, we're going to cover all this in our upcoming slides. So we'll start with the basic. So as we spoke about old tax regime and new tax regime, we have two different regimes. In that, in old tax regime, you will be able to make it, you will be able to make investments under certain sections and deductions and make most of it. So starting with section 80C, that's most popular in tax saving investments. So one thing is up to 1.5 lakh, you can make any contribution to PPF, EPF, ELSS, equity linked savings schemes. Your life insurance premium can be utilized. Your children's tuition fees. So let's say it's like if the entire annual tuition fees or school fees is 1 lakhs. If you see the breakup of the fees of the children, there would be specific fee mentioned like 15,000, 20,000 and so. That fees also can be claimed under section 80C up to 1.5 lakhs. So you can make most of it by claiming this 1.5 lakh limit under the section 80C. Apart from that, you can additionally contribute around about 50,000 under National Pension Scheme and make most of it. Why National Pension Scheme is actually an interesting investment avenue, because there's a lock-in till you're 60 and 65 and so on till your retirement. So this is gonna help you in keeping the investment habit intact, and because this is not easily liquidable, you won't be able to liquidate from this NPS corpus that easily unless it's under NPS Tier 2. So there are two different ways you can invest in NPS is NPS Tier 1 and NPS Tier 2. So in NPS Tier 1, it's going to be locked until your retirement. In Tier 2, you won't get specific tax benefits, but you will be able to invest in this specific investment revenue. Apart from that, moving to Section 80D, medical insurance and critical illness insurance premium. So let's say it's like for yourself, spouse, and your children, so you're paying up some family floater cover, medical insurance cover, up to 25,000, you can claim deduction under Section 80D. But for senior citizens, there's a different catch. Up to 50,000, you can claim for whatever medical premium or health insurance premium that you're paying for your parents and so. So in that case, let's say it's like if your combined family of 5 to 6 people, and if your family floater cover for you, self, spouse, and children, apart from that, you're also paying premium for your parents too. Combined maximum, you can invest up to or make the use of 75,000 limit under Section 80D. So this is also one thing that, because we generally talk about investments, tax planning, and all. So getting first things right would be insurance. So having this set right is also going to be the one important factor. So having a term insurance and health insurance is very important. And obviously, we'll be able to make use of the deductions and like reduce the tax liability under Section 80D with that. So these are the few key points to note under the Section 80C limit. So it's like for the life insurance premium that we had mentioned. So it can be claimed for self, spouse, and children, but not for your parents. So let's say if you have any life insurance premium or a term insurance premium for your parents' name and something, and if let's say if you are contributing for that, you won't be able to claim that specific amount under Section 80C. Apart from that, in public provident fund, this PPF is indefinite extension. Let's say the maximum or the starting out when you're starting out a public provident fund, the tenure is going to be 15 years. After that, you can keep on extending the PPF maturity for a block of 5 years for unlimited time and make use of that under the Section 80C tax benefit. And also it's like consider investing before 5th of every month to maximize interest, because as per the previous guidelines, they're going to be calculating the interest on the corpus that's there before 5th of every month. So that's one thing. And for EPF, as I said, it's like under Section 80C, you would be able to like deduct the contributions made under the Section 80C for EPF. Only employee contributions can be considered as deductions. So if your employer is paying something towards your EPS or EPF, that won't be calculated or won't be counted under the EPF deduction or the Section 80C deduction. And there's also one thing called as Sukanya Samriddhi Yojana. That's actually one of the interesting and excellent investment revenue that you can have for your girl child. And in that also maximum contribution you can do is up to 1.5 lakhs. And according to the income tax rules, the maximum age of the girl child should not be more than 10 years if you're starting an SSVI account. So you can start when the child is born or if it is below 10 years and so, and keep on contributing till she is 18 years old and plus. So these are the few key points that we thought like you have to be known. So coming to the next deductions that people need to be aware of. Let's say it's like if you're a salaried employee, but still it's like you're working towards some education part and you have taken an education loan. Apart from that, if you're paying for a child's school fees and an education loan, total interest that you're paying up towards this education loan can be claimed as deduction under Section 80C. There's no maximum limit as of now. Apart from that, Section 80G, donations. If you're like contributing something from your cash flow towards any charitable trust, political organization, and so on, up to certain percentage based on all the other factors, you will be able to claim deductions under Section 80G. Apart from that, there's also one rule is Section 80 TTA. In this, it's like if whatever there's an interest on your savings bank account, if it is just up to 10,000, you can claim it as deduction under this particular section. So this is also one thing that we wanted to keep in mind. So apart from that, there is also a few other sections that can be like kept in mind. One thing is like Section 80 EEB. If you're purchasing an electric vehicle, so up to 1.5 lakhs, whatever interest that you're paying up to 1.5 lakhs can be claimed as a deduction under 80 EEB. For any medical treatment, it's like if you're paying any fees or expenses for the specific disability and so on, up to 75,000 can be claimed, and in certain cases up to 1.25 lakhs in case of severe disabilities can be claimed under Section 80U. Apart from that, let's say if there's any other specific medical expenses or thing or certain like specified elements that gonna happen in specific financial year. For self or a dependent up to 40,000, you can claim under Section 80 DDB. So in this also, I would like to talk about something that we have not mentioned, Section 24B. So in this case, what's going to happen if the property that you're purchasing and you're taking a home loan for that, whatever the principal amount is up to 1.5 lakhs, you can claim it under Section 80C. But on the interest part, up to 2 lakh, if it is the property where you're going to stay in, so in that case, up to 2 lakhs, you can claim the interest under Section 24B, whatever interest you're paying towards your home loan. But let's say if that property is a let out property, there's no maximum limit. Whatever interest you're paying it for the specific financial year can be claimed under Section 24B. So it's like we'll start with some case studies because it's going to be too hectic if I just keep on talking about some tax regime and deductions. So let's say, okay, we'll meet Ram. The cost CTC of that Ram is around about 12 lakhs per annum. So what do you think, what tax regime would be ideal for Ram? So there are two factors. He has to choose something between old tax regime and new tax regime. And what's going to be the most deciding factor is the more the deductions, it's better to choose old tax regime, right? So let's say it's like what's the case with Ram. So in the Ram's case, the total standard deduction for all the salaried employees, it's going to be same and it's available under new tax regime too. It's going to be 50,000 each. Apart from that, Ram is contributing towards his PPF, EPF, so he's having Section 80C deduction of 1.5 lakhs. Apart from that, Ram is also claiming home rent allowance, house rent allowance, HRA of 1.2 lakhs. So from gross income of 12 lakhs under old tax regime, his net taxable income is just 8 lakh rupees. So based on the tax rates and everything, the tax liability with cess is going to be somewhere around 92,040. Even in spite of all these reductions of ATC and AT, HRA and all, under the new tax regime, as the slab rates are on a lower side, the gross income being 12 lakhs, standard deduction of 50,000 being common for old tax regime and new tax regime, the net taxable income under the new tax regime for Ram is going to be around about 11 lakhs 50,000. So the total tax liability under new tax regime is much lower than the old tax regime because the tax reductions are much lower on the old tax regime and the slab rates are more on a favorable side for the investor and salaried employer. So hence, obviously for this specific financial year, I would also recommend Ram to go ahead with new tax regime. And also it's like one thing that I wanted to point out is you have the flexibility to choose new tax regime and old tax regime every year. It's not the same for a business person and professional. But for a salaried professional and an employee, you can actually like switch in your old tax regime and new tax regime every year based on your tax liability and based on your tax reductions. So let's say it's like we'll see another scenario with Alia where her CTC is around about 25 lakhs per annum. So again, in this case, what tax regime would be ideal for her? So let's see again with an example. So in this case, if you see, there are a lot of deductions that Alia is making use of. So one thing is Section 80C of 1.5 lakhs that we have covered. She is contributing towards NPS, 50,000 from her financial savings or her cash flow. She's contributing towards NPS under Section 80CCD. She's making use of the 50,000 deduction limit. She's also having some health insurance and medical insurance premium. So she's making most of the 25,000 as a medical insurance premium. Apart from that, as I said, if it is a self-occupied property, and if you're having a home loan, up to 2 lakh, the interest amount, you can claim it as a deduction under Section 24. So with all these deductions, a gross income of 25 lakhs has come down to 20 lakhs 25,000. So with this, a total tax liability with cess, education, health cess and all together, it's going to be 4 lakh 36,800. Whereas in new tax regime, there's only one standard deduction that we can make most of it. So after that, the net taxable income for Alia is going to be 24 lakhs 50,000, with which the tax liability is going to be 4.5 lakhs. So there's a difference of exactly an approx 15,600. So yeah, every 1,000 matters, right? So hence, in this case, in what I would recommend Alia is to go ahead with the old tax regime. So you may ask, it's like, how should I like come to the conclusion of what tax regime to choose? You can reach out to your advisor. They would be able to help you out. Or apart from that, it's like if you just log into the income tax portal and see the income tax calculation sheet, and you just need your payslip from your employer and just feed in the details of old tax regime and new tax regime, you itself would have a great clarity about, okay, my tax liability under old tax regime is better because I have a lot of deductions. So I will move ahead with the old tax regime. So that is also one thing that I would recommend. You can also try it on your own, or else you can reach out to your financial advisor is what I would recommend. So we'll go deep and dive more about exemptions and deductions. These are two different things. So we'll see one scenario. Meet Karthik and Anil. They both have a CTC of 24 lakhs and they both work in the same company and have same designation. They are both 30 years old. So let's take a look at the tax journey and how exemptions and all these deductions is going to help out and make a major impact in their savings. So, okay, exemption and deduction are two separate things. So exemption is one thing that you get from your employer and that's exempt from the tax. You're not liable for taxation on all the exemptions that you get, but you need to claim the certain exemptions so that it's completely exempt and you're not liable for taxation. Deductions are something different. You make these investments and you can help, this investments can help you reduce your tax liability, like Section 80C, that's PPF, EPF, medical insurance premium under Section 80D, NPS of 50,000 under Section 80C/CD, and so on. So more about exemptions, what I would say is, it's like, let's say it's like everyone would be aware about home rent allowance, right? So every salaried individual, most of them might be living in a rental accommodation and so on. So you have the opportunity to claim the HRA allowances. So how you can calculate a home rent allowance or a house rent allowance would be, there are three categories. Whatever is the least of following, you can claim as an exemption. Actual HRA received is 1 point. Second is 50% of the salary, basic plus DA, DNS allowance and so on, for those who are living in metro cities. 40% of non-metro cities, 40% of salary for non-metro cities people, and actual rent paid minus 10% of salary. So in these three categories, whatever is lowest, you can claim as an exemption for the home rent allowance. Apart from that, you might have already heard about leave travel allowance also. So most of the salaried employees, if you just go ahead and decode your pay slip, you will see something that is leave travel allowance. So cost of travel incurred by the employee for travel within India. So it covers for only travel expenses. It won't cover your food, your hotel stay, and so on. And this can be claimed only for 2 journeys in a block of 4 calendar years. Apart from that, one thing that it's like most of us are already aware about is it's like convenience allowance, food coupons like Sodexo and so on. And apart from that, there is something called children's education allowance also. So it's exempt up to 100 per month per child if it is maximum of 2 children is what I would say. So moving ahead to the next slide. So yeah, Karthik doesn't claim any exemptions and so on and doesn't submit his proofs. So it's like, okay, let's say you are opting for tax regime on the start of this financial year. So obviously you would have already informed your HRA or a finance team that you would like to choose a specific so-and-so tax regime for this financial year. And at the end of financial year, obviously you will be submitting certain proofs like HRA, your leave travel allowance, or some medical coupons or meal coupons and so on, sorry. And in other case, let's say what's happening is Anil is actually using all this following exemptions and submitting his proofs. So right now, from the entire gross taxable income of Karthik, it's going to be somewhere around 21 lakhs 45,000. But whereas in Anil's case, as he is actually making use of all these exemptions of HRA, LTA, and so on, his taxable income has come down to 16 lakh 86,000. So moving ahead, I'll be passing on it to my colleague Nakul Janakiraman. He's going to take across and explain what are the ways how Anil and Karthik is going to like make most of this tax liability and reduce the tax liability. Yeah.
Thank you, Vinayak, for taking us through a wonderful session on tax. Now that the basics are kind of put forward, let me take you through certain examples where we work through whether the new tax regime works for someone or the old tax regime works for someone. So again, even before we go ahead, this will be highly dependent on what the individual earns and how much that they can claim and what are the deductions that they're currently claiming. And one more thing is, I see a lot of people investing or making certain decisions only for the sole reason of lowering their tax. See, that does not make sense. If you want to invest, or let's say if you want to let's say take a home loan, that should be the sole reason for it. Tax saving should be only the secondary reason, because I see a lot of people taking these commitments, long-term commitments, and being stuck because they felt that the tax might be lower. So now moving on, we'll take two kind of scenarios. One with Karthik having he's a salaried person, he's earning from salary income, but he doesn't claim any exemptions and does not submit any proofs. On the other hand, we have Anil, who does claim a lot of existing deductions that we have. Let's see how this works out. Karthik has a gross taxable income of 21.45 lakhs and Anil has a gross taxable income of 16.86. Even though Anil has a lower income, let's see how tax impacts their cash flows. Kindly move to the next slide. Okay. Let's take the Karthik and Anil with a gross annual income of 21.98 lakhs each. Standard deduction can be claimed in both the old and new tax regime. There's no difference there. On the HRA side, even though Karthik pays the rent, he does not claim it. But on Anil, he claims it under the old tax regime for rent paid as 40,000. So that will amount to around 3.8 lakhs. Professional tax is something that, again, it gets claimed automatically. Leave travel allowance is another important thing, because if you do not claim it, the entire amount will be taxed as per your tax slab. Now, what are they both doing? Let's say they both follow old tax regime. They both can claim the LTA. So when they both claim it, Anil, they both can claim it, but Karthik does not claim it, and Anil is the only one who claims it. So LTA kind of reduces his taxable income by another 50,000. Meal coupons. This is a very, very underrated thing. Most people do not claim it. You have things like Sodexos, auto cards that can be used. Karthik does not claim it. Anil again claims it. And this brings their gross taxable income, what we saw in the previous slide. Even though they earn the same amount, the tax that Karthik will be paying will be on 21.45 lakhs, but Anil will only pay on 16.86 lakhs, automatically lowering how much tax he'll pay. Next slide, right? Okay, now going through the deductions in some more detail. So if you look at it, Karthik's income tax is 21.45 is his taxable income. And if we remove the ATC, which will get deducted from things like his PF and things like that, the net taxable income for him will be 20.29 lakhs. And what he'll pay as tax on that income is 4.51 lakhs, which is quite a high amount. Now let's look at how Anil's works out. Anil has someone who has kind of used a lot of these regimes into place. So he has claimed ATC, he has claimed ATCCD, ATD for health insurance, ATC for PF insurance policies, term insurance policies, things like that. ATCCD again for things like NPS, ATE if you have taken an education loan, ATTTA for things like interest on savings bank. So there's a maximum of 10,000 that you can claim on interest on savings bank. So that is another kind of underrated section. So his tax liability is only 2.4 lakhs. Now that is very good, right? See, by claiming all these deductions, he's left with a lot more income that he can use to consume, save, invest, do whatever he wants to do. So that is the impact of efficient tax planning. Next slide, Ryan. So how much was Anil able to save? Anil was able to save close to 2.11 lakhs on his tax liability. Now, let's take a scenario where you take the tax savings and you invest it in something like an equity instrument. Equity instrument can be something like just like a mutual fund. And let's see how the compounding works in your favor just by optimizing your tax liability. Next, please. Okay. Let's take a scenario where 5 years later, both of them switch jobs and let's say they get a salary hike. Anil consistently invested the amount of tax saved into equity instruments at, let's say, a conservative rate of 9% CAGR. So whatever he saves, let's say 2 lakhs per annum, he invests it in an equity mutual fund for the next foreseeable future at 9% compound interest growth rate. Let's see how this impacts his wealth. Now, 5 years later, he has a corpus of 13 lakhs. So that is quite a sizable corpus. And let's say if he lets it run for another 5 years, the compounding will take place on this 13 lakhs in place. And one more thing with equity is that equity is the instrument that is taxed most favorably. For short-term capital gains, you're taxed at 15%, and for long-term capital gains, you're only taxed at 10%, subject to a 1 lakh initial exemption limit as well. So anything after that 1 lakh will only have to be paid as tax. So that is where equity comes on top, because Yes, there is risk involved, but over a long period of time, you can compound your capital at a higher rate than inflation. Next, please. Mm. So what we kind of see is that most people have a couple of questions and maybe a little bit of clarity that they require. What happens when they move jobs? Well, some of the questions that we kind of received is, can my PF be transferred? Yes, your PF can be transferred. The EPFO has also come out and said that each person can only have one UAN number. So yes, if you do have two UAN numbers, you need to merge them together so that the interest kind of gets generated. Otherwise, if your PF account is left dormant for a period of 3 years, without any kind of employer contributions into it, it will stop earning interest. So make sure to merge your UANs if you have two or more UANs. What happened to my gratuity? If you work for a company for more than 5 years, you receive gratuity. Gratuity can be transferred to employers. In the off chance that an employer does not have the provision, you can always withdraw all your gratuity and take it with you, and maybe put it in a debt fund, or maybe open a VPF and put it there, or maybe even invest in equity instrument. So yeah, that option is always there. But yeah, gratuity can also be transferred. Should I submit any forms to a new employer? Yes. So let's say you kind of left the job in the middle of the year. So that means forms like your form 16 and things like that will have to be submitted to your new employer, so that additional tax does not get deducted on your new package. Or let's say they do not kind of under deduct tax, so that at the time of filing, you'll have to file more. We see this happen a lot where people kind of left their job and the new employer does not deduct a lot of tax. And because they do not submit their Form 60 at the time of tax filing, they have to pay additional tax, and this kind of becomes a strain on their cash flows. Can I claim deductions twice? No, we see this question asked a lot. No, that is not possible. That is not legal as well. Should I abstain Form 16 from both employees? Yes. If you quit during the middle of the year, you need to have two Form 16s before you kind of file tax. Next question. Okay, now let's dive a little bit deep into different asset classes and how are they taxed and what are the tax rate. Now let's say Anil and Karthik, the same two people from the examples before, started investing in different asset classes after 5 years. They invested with some options, as let's say real estate is a very, very popular one. Gold, again, it's a very, very culturally important and emotionally important asset. Equity shares and mutual funds, this is picking up steam. Debt mutual funds, again, fixed deposits, a worthy counterpart. Now let us see from the rules of tax on their income, how each asset class is taxed. Next. Yeah, super. So let's look at listed shares in India. If you look at listed shares in India, how it is taxed is that if you hold them for a period less than 12 months or 365 days, it is taxed at short term with taxation at 15%. Now, if you hold them for a period of more than 365 days, they classify as long term, and they will be taxed at a favorable rate of 10% with a 1 lakh per year as exemption. Another thing is debt funds. Now, debt funds used to have favorable taxation when compared to an FD. They still are better than an FD if you ask me, but debt funds, any gain or interest from them will only be taxed at slab rates similar to an FD. But in an FD, every quarter, TDS or tax is deducted at source as per your slab rate. But in a debt fund, tax is only deducted once you withdraw from it. So you can defer your tax, let's say for a period of 2 years, 3 years, or 4 years when you finally need it. But even if you lock into a 2 or a 3 year FD, even though you do not withdraw from it, tax is still deducted in every quarter. So that is where debt funds will give you tax-free compounding. In FD, compounding happens after the tax is deducted. For real estate or unlisted securities, short-term capital gain is as per slab rates, which is the holding period is also for 24 months, not 12 months, 24 months. If you hold it for a period of more than 24 months, you get favorable taxation with 20% with indexation. So these are how the most common instruments are taxed. If you do have foreign equity in the form of ESOPs or RSUs or employee stock purchase plans, these are taxed similar to immovable property, where short-term will be for slab rates if you hold it for less than 24 months. If you hold it for more than 24 months, it will be taxed at 20% with indexation. Next slide, please. Okay. I addressed it on the previous slide, but we'll go through it again. 10 years later, from the time they join their job, let's say they receive ESOPs. Now, ESOPs have become a very common kind of thing. But what people do not know is that ESOPs are always tax-wise. This has nothing to do with claiming the double taxation agreement. That is completely different, which I will go through slightly later. But to know about ESOPs is that once you receive your ESOPs as a perquisite in your salary, it is taxed once. Let's say they give it to you at, let's say the market value is at 10 rupees. They give it to you at an excise price of 2 rupees. If you excise at 2 rupees, that 8 rupees will get taxed. That's simple. That has to take place. Let's say you hold it for a period of, let's say, more than 3 years or 4 years. So long term, more than a period of 2 years. On disposal, the capital gains, let's say from market value of 10, let's say it has grown to 15 rupees. So that 5 will be taxed at 20% with indexation on disposal. So one on exercise when you get it as a perquisite, the second time when you sell it, capital gains will apply. So this is always part of ESOPs as well as RSUs, as well as any kind of employee stock purchase plans that you have. So keep in mind these things, keep in mind things like your vesting period as well. Now, for shares where they are taxed in the US and they again kind of get taxed in the Indian context, one thing that you can do is, though it is a bit complex, double taxation avoidance agreement with the US can be claimed. It has to be claimed in India because automatically the tax is deducted in the US. So once you claim, once you kind of pay tax in India, when you file your taxes, you can ask your auditor to claim the DTA. Once you claim it, you'll get it back as a IT refund. So that's another motivation to file an income tax refund if you have ESOPs. Next slide, please. Now, coming to your next step, see, these are some of the things that you have. If you've seen kind of a half-boiled kind of an omelette, you will kind of see that there are two parts. One is the yolk in the middle. Surrounding it is the white matter. The white matter is what supports your core. Your core is what is going to grow money. Now, to protect your core, you need things like an emergency reserve, some kind of a health insurance, some kind of a life insurance, some aggressive instruments in equity, so that the yellow matter is protected and the white matter can grow bigger and bigger, so the protection layer is bigger and bigger. What we see most people do is they do not take into account all these things and straight away jump into things like tax saving. Tax saving for the purpose of tax saving will not get us anywhere. Let's say we invest in an instrument and you need that instrument, but let's say it has the additional benefit of tax, then that's okay. That's a double advantage. But let's say just because new tax regime does not have health insurance deduction, you do not invest in health insurance or life insurance, well, that is going to impact you in a much bigger way than let's say if you had missed out on some part of tax. Now, the core is where things like your PF, your pension, your gratuity, let's say some of the ELSS mutual funds you invest in, all this kind of forms your core. Your core is what is going to provide you in your retirement years, what is going to provide you for your goals and things like this. So keeping these two things in balance is where an asset allocation standpoint kind of comes in. And asset allocation plays even more crucial than what mutual fund or what kind of share you select. Because once you have your asset allocation in place, everything else automatically falls into place. Next question. Next slide, Brad. Let's take another scenario. If Anil continued to invest the 2 lakhs per annum in the tax saving instruments, he will have around 1.7 crores in 25 years. That 1.7 crores will form a significant part of, let's say, his retirement corpus as well. So all he needs to do was claim his tax deductions and put it away in, let's say, a growth instrument, which gives him a 9% compound annual growth rate. Sounds simple, but very, very hard to do because behaviorally, staying invested for 25 years is a very, very hard thing. That is not very easy. That is where we as advisors come in to kind of handhold you, advise you, and kind of help you, guide you through that kind of journey. I'll just go over some key points that kind of we need to keep in mind, and we can wrap up. The first step is to find the regime that works for you. Old versus new tax, again, a very, very kind of a controversial topic, I would say. Some people want this, some people want that. Some people, even though they get to the lower kind of tax tax liability in the new tax regime, they still stick with the old tax regime just because they want to claim all of the deductions. But yeah, finding that out is the first thing. Working out the calculations is another thing. Find a CA who will kind of work out the calculations and show you, and then you proceed with it. That's the way to kind of go for it. Smart way of tax planning includes appropriate investment planning. Do the investment planning first. The tax planning can follow, because selecting in instruments like, let's say, a money back policy, or let's say an endowment policy, just because they're tax advantage, will not make any sense for you in the long run. Understand the power of compounding while considering tax saving investment. This is very, very important. Again, tax saving instruments are good, but if tax saving instruments is only going to give you a 6 or 7% return, that does not make sense. That will not make sense for you, because that will kind of lower the potential of what you can have accumulated. Structure each component of your salary. If you're someone who is, let's say, living with your parents, but can still, let's say, pay rent to them, HRA can be claimed in that aspect. So you can make a kind of use of deductions like these. Don't restrict tax savings to ATC alone. Yeah. If you're stuck with the old tax regime, go for things like, I know home loan is something that people do claim, but go for things like health insurance, go for things like NPS. If your employer is contributing to NPS, that is even more better. That's a great situation for you to be in. So keep some of these kind of situations in mind. Analyze what tax regime, the old or the new one, that you guys would want to go for it eventually before selecting it. So that is something you guys should keep in mind. Next slide, please. Now, tax is only one part of your financial plan. See, you having a budget, having insurance, proper insurance, not your money back or endowments, having something like a term and a health cover, maybe car insurance as well, a vehicle insurance, a property insurance. These are the insurance that you actually need. Being, of course, tax efficient. If you have some debt, you need to know how to manage it. Of course, you have your goals. Each goal will require a different type of investment process. A short-term goal will require a different approach. A long-term goal will require a different approach. Selecting the appropriate instruments, having the asset allocation in place, all of these are places where a financial plan can help you. Tax is only one aspect. A financial plan covers all of this, including tax as well. So that is where getting your financial plan from my SEBI RA is very, very crucial. The license plays a key role, because you know that they are experts at what they do, and they have seen scenarios like this before. Next, Vinay. Super. So I'll open the floor for any questions that you might have. I've been answering some questions in the Q&A box as well. If you do have any questions, please post them in the chat box. Me and Vinayak will be happy to answer.
Nakul, you're on mute.
Oh, sorry, I hope I'm audible now. So Chidambaram sir asked, what is the benefit of transferring gratuity? Sir, it's just like your PF or things like that. It gets accumulated each year. When you transfer it to an employee, it will be like a fund that they maintain. In the off chance that there is no gratuity there, then yeah, it becomes a little bit of a struggle where you do have to withdraw it, and hopefully you put it. It's a saving instrument. Hopefully you put it in other saving instruments as well. I do get a question. Please explain for the person doing trading only, no other way of income. Yes, sir. Yes. So for a person who is doing full-time trading, whatever income you earn from trading will not be taxed at a 15% rate or a 10% rate. It will be taxed at the full tax slab rate. Trading is a speculative way of doing things. We do not recommend that here, but from a taxation point of view, it will be taxed under a tax slab. Let's say you make gains of, let's say, 20 lakhs from trading. This will all be taxed under the tax slab rate. There is no preferential rate. Trading is speculation. Speculation is always taxed at tax slab rate. Any suggestion on ELSS tax saver funds? So we do not give out any fund suggestions as such. Please, we'll drop our contact links, Vico. Please feel free to contact us. We can kind of help you set up a mutual fund portfolio with us. We do not offer any kind of suggestions on tax or stocks.
Mm.
Uh, if you guys have any other questions, do drop them in the chat. We'll answer them. Is there any tax benefit in InvIT dividend? So no, sir. Dividends are already taxed. So dividends are things where they'll get already taxed at the corporate level. So you'll get a favorable taxation when you kind of receive it. But yeah, it'll be added onto your tax slab and you'll have to pay that.
Also, actually, there's one question by Chidambaram sir in Q&A. So do we get interest in that gratuity transfer? So no, sir, it won't be something like a savings or an FD. It would be just a benefit that you would get once you exit a company or like once you terminate an employer thing. So it's kind of a retirement benefit or a gratuity benefit if you're leaving that specific company.
How many Bitcoin investment? Okay, sir. A Bitcoin transaction, Bitcoin is taxed at, so any cryptocurrency is taxed at 30%. So 30%, the highest rate with the highest amount of cess and tax applicable. There is no slab rate there. So it'll get taxed at the highest. Can we claim personal loan interest used for housing purpose? No, sir. You cannot claim any deduction on personal loan that is used for housing purpose. Preferably, an extension of housing loan should be taken, but if personal loan is taken, that interest cannot be claimed. So if okay, so I'll take this. What is the procedure for short-term capital, long-term capital gain in share market? Please explain tax percentage. So how it works is that short-term is anything less than 12 months, sir. Long-term is anything more than 12 months. This is for equity mutual funds as well as equity shares. So if we hold anything for less than 12 months, it will be taxed at 15%. The gain profit will be taxed at 15%. Hold anything for more than 12 months, it will be taxed at 10%. But before this 10% applies, the gain, 1 lakh of gain is exempt from taxation. So let's say if you have 2 lakh of gain, 1 lakh is exempt. Only on that another 1 lakh you have to pay 10%. So subsequent gains are taxed at the same 10% rate. One more thing to note is that can it be carried forward? Losses can be carried forward for 8 years. Any capital losses can be carried forward for 8 years. and it can be used to reduce your gain. So how it works is long-term capital losses can be set off only with long-term capital gains. Short-term capital losses can be set off with both short-term and long-term capital gains. How can we optimize the sale of immovable property in tax savings? So what you can do is, let's say, if you sell a immovable real estate and you kind of move it to buy another real estate property, then you do not have to pay any tax. But let's say if you sell the real estate and if you buy something called 54 EC bonds, there's a 50 lakhs limit to it. So maximum 50 lakhs is what you can do. Then also you do not have to pay any tax. But please note, these bonds have 5 years lock-in and they come with a lower interest rate. So these are the ways that you can kind of optimize immovable property taxation. From YouTube, can you explain again RSE ESOP tax refund claim received from foreign employer that you mentioned during the webinar? Okay, so okay. So how?
Yeah, you can take it.
No, go ahead.
So okay, so it's like what's going to happen is, let's say it's like if you're working with a let's say US employer, and they're going to give you some ESOP of, let's say, they at a certain agreed date at a certain agreed price. So okay, this year I'm supposed to get 100 shares of at ABC company, and the discount I'm getting is 800. The price I'm getting the discounted is at 800 rupees. But at the market, it's going to be trading at let's say 1,000 rupees. So whatever the difference is in the discounted rate that I'm going to be vested, it's going to be vested under my name, and whatever is trading in the market, that difference would be taxed and would be like attached to my slab rate. It would be taxed at my slab rate. And once that is vested, it's going to be under your name, like a listed security or the unlisted security. And based on that, it's again going to be taxed on your capital gains whenever you're going to sell. So for ESOPs and RSU, there would be two tax implications. One is once it is vested, the discount and the market price would be taxed. And second time, when once you're going to sell it, you'll have to pay the capital gain taxes on the same. So is mutual fund more tax efficient than FDs? Okay, let's. I'm assuming this is regarding the short-term debt instruments and so on. So let's say what's going to happen is if you're investing or parking around about 10 to 20 lakhs in FDs, you would be getting interest on a regular basis, on a monthly basis, and so on. And at the end of the financial year, you would be liable to pay taxes on the same. But let's say it's like in short-term debt mutual fund, if you are not requiring that interest, you won't be anyways getting any interest payout. It will just accumulate and compound. It's something like a compound interest. It's going to accumulate in the fund. Only when there's a redemption, you will be liable for the capital gain taxation of the same. It's anyways similar to the slab rate only, but one thing is it's going to be delayed. So let's say if I am going to prepare emergency reserve for myself, I would prefer short-term debt mutual funds more, because considering I would be able to delay the taxation, and in FDs I'll have to pay the taxes on the interest every year-on-year basis. Hi, what's your view about NPS in salary, 10% reduction, and NPS in self-investment, PPF, ELSS, term insurance, and all over Section 80C? So yeah, so it's like obviously, as I said, it's like there are some cases where employer-sponsored NPS is also there. In that case also, it's going to be tagged in the deduction. Apart from that, like yeah, under Section 80CCD, you would be also able to like make most of it by contributing 50,000 additionally and bringing it down the tax liability. Obviously, there would be a lock-in for the next so and so years, but yeah, comparatively, it's one investment avenue that you can have in your portfolio, considering an asset allocation. Because major cases that we see is if a certain person is starting an SIP of, let's say, 20,000 also, the continuity is very less. They might start it for 10 years, 15 years, and again, like shift it out based on the market sentiments and so on, or if there are any financial goals. But in NPS, the case is you're continuously contributing it towards your retirement. You don't have any like option to liquidate it. Hence, that's one of a good option to like, yeah, build up some retirement corpus for your retirement. Yeah. Except ATC, what are other tax benefits for NRI equity investors? So it's like for equity investors too, the tax liabilities are similar as of Indian investors. The only difference is, let's say for an NRI, so for a resident Indian, if I am selling some stocks or mutual funds, and if I'm having a capital gains of, let's say, 2 lakhs, I have to file the taxes on that during my tax filing date in July 31st and so on. But for NRIs, what happens is, once the capital or the security is sold, the TDS is automatically deducted. And let's say if you're not falling under the slab rate, you can claim it back while filing taxes in India. So that's one of the main benefit for NRIs, I would say. How much can I save in old regime? I have completed investment 1.5 lakhs, ATC, ATD, and any other option available. So ATCCD is one option available where you can contribute towards your EPF, sorry, NPS. Apart from that, if you would like to reduce the tax liability by doing some donations for some charitable trust and so, there's still section 80G that's available. Yeah, apart from that, if you have some education loan or home loan, yeah, there are other sections available like a section 84, section 24B for home loan interest and section 80E for education loan interest. So what regime is good if we cross 25 LPA? So sir, there's no specific set of standard like this regime is going to be beneficial for you or no. It depends upon all the deduction that's available for you and so let's say it's like if you have like a lot of reductions like home loan, education loan, EPF, PPF, and HRA and so on. In that case, like obviously like old tax regime might be in favor of for you. But one thing is it's like okay, there's two point of view for that. As a financial advisor, I would always see is in this case, let's say if I'm doing some tax saving investments, I'm missing out and I'm not having any cash liquidity in my hand. So in that case, new tax regime suits some certain set of salaried people because they will be able to like, slab rates are lower. Apart from that, they would have some cash balance in hand that they can compound at a better rate of return rather than locking into EPF, PPF, or NPS and so on. So yeah, it's going to be different from person to person and so on. So there won't be a specific set of standard.
What is 64B? So 64B is an income statement that is usually provided for private trusts, if I'm not wrong. So it is normally an income statement provided by a business trust to some kind of a unit holder. When a trust kind of files its income tax, it will use it. For individuals, this is of no use, sir. So if people are doing investments in their name of their trust, then they will need to file this. Is it given to Form 15G for FDs for taxpayers or yes, sir? It is very good. It is very good. Submitting Form G is very good. Uh, 1 lakh exception of LTCG available in new regime. Yes, sir. Yes. Correct. It is available. It is available. So for special rate, it is not between old or new. It is always available. Vinay, do we have any other questions?
Actually, there's one more question. What all are the exemption and deductions allowed under the new tax regime? I heard interest on let out housing loan is permitted for deduction. So what is any other deduction? So there are certain exemptions like travel allowance and so that are obviously available for new tax regime also because it's not a tax and investments that you do. It's a employer exemption that you're getting from your employer. Apart from that, one thing is it's like obviously standard deduction of 50,000 is available for old tax regime and new tax regime. And section 80C is not available. Other section like 80CCD premium is not available. The home loan premium is available, sir. Like let's say if you're having a self-occupied or let out property under section 24B up to 2 lakhs, you'll be able to like claim the same. So that's one thing that's available under the new tax regime. Nakul, have you answered this already? The 1 lakh exemption for LTCG?
Yeah, that is answered.
Oh, okay, got it.
Do you have anything else? Okay, thank you for explaining tax and capital gain. Can you please repeat about set off of short-term and long-term capital losses? So, correct me if I'm wrong, Vinayak, but short-term capital losses can be used to set off both long-term and short-term capital gains. Long-term capital losses can be used to set off only long-term capital gains. So you can think of it like this. If you have a long-term capital loss, only long-term capital gain. Short-term, both short and long-term. Also, to carry forward order, what is the process? So there is not any process. If you have declared the loss in your previous ITR, this will again show up in your new ITR that you're filing. How to do it? Please explain. Last year I did not show my loss in. So that's okay, sir. You can always file for a revised ITR and you can show it there. Then it will show up in the new ITR. Or else you can just you'll have to do the revision. Then only it will happen because the loss will be for the previous financial year. Again, so how to show that loss incurred in the last year? So the revision of ITR is what you'll need to do, sir. This is not a very complex process. You can do it. It should be simple enough.
So there's one question: is your team helping out for tax filing? So we are right now not helping out in tax filing specifically, but it's like we can help you out in tax planning and let you know it's like what is the best way to reduce your tax liability and strategy of it. So it's like apart from that, so it's like you can just reach out to your auditor and so on after having a discussion with your financial advisor. Like, okay, these are the tax deductions I want, and yeah. Because at some cases, there are a few scenarios that like auditors also do miss out on the certain deductions and so. Because we recently saw a case where there was a professional doctor who was filing taxes under the slab rates and so on, but they were not aware about the 44 ADM, presumptive taxation and so. So yeah, under presumptive taxation, what happens is only 50% of the total receipts that you earn is liable for the tax. So that's the case. So one thing is you need to have a word with your financial advisor, and for filing taxes, you can surely reach out to your auditor.
Maybe I can answer it, Vinayak. What are the taxes for what are the charges for tax and finance by the organization? Do you have any plans for retail and small who can SIP or for PMS only? Sir, we do financial planning. We can help with tax advisory. We do have mutual funds for any investor that there is, small or big. Does not really matter. We are here to help. You can always reach out to us. Maybe you can show the next contact slide. We shall drop our contact here, and please do reach out to us. We'll be happy to help, sir. So if that would be all for the questions, thank you guys for joining us on this lovely Saturday morning. Thanks for taking time out to join us. Hopefully we were able to help you. And if you guys do have any further questions, drop them to us by mail or do contact us. We'll be more than happy to help you guys. Again, thank you for joining us. We'll have similar webinars like this planned for every kind of weekend. So, join us for those as well. Thank you.
Nakul, there's one last question of MF, mutual fund investment.
Do you advise how to rationalize MF? Yes, we do. We are a mutual fund distributor. We do advise on, we kind of help you set up portfolios and help us invest through us in mutual funds as well. So yeah, that is a service that we provide. I think there's one more question. My son is studying, not working.
So, sir, my son is not studying and not working. Suppose we invest on shares in his name, should we pay tax? So one thing that's going to pop up is clubbing of tax. Let's say if you're transferring some money in your son's name and directly investing in that case. So it's like on the first investments that you make under the son's name, you will be able to liable for the taxation part. And from whatever proceeds he gets, if he goes and reinvests somewhere else, son would be liable for taxation. Apart from that, there's one thing that we usually miss out on is gifting. So as these people are close relatives like spouse, children, and so on, blood close relatives. In this case, you can gift a certain amount to them in their name. There's no maximum limit on that. And you just need to file, while filing ITR, you can show so and so amount has been gifted from my end to this specific person, specific family member. In that case, the entire tax implication will be just transferred to the son. but we need to make sure that we show it while filing ITR, that we have gifted so and so amount from our income to the specific person. I guess it's like we can wind up now. Thank you all for the patience and it's like joining us on the Saturday morning. Hope you all have a good weekend. And yeah, let's see it's like how we can make best of for you, and we'll surely help you out in reducing your tax liabilities. Do reach out. Yeah. Thank you.
Thank you, guys. Thank you.